Part B, 12 marks. Let's go through the question. In December 2019, Mike approaches your firm again. He tells you that he recently underwent a very traumatic experience when a group of armed men broke into his house and tied up his family. He has decided to immigrate to Italy, where many of his international customers are situated. Mike plans to immigrate to Italy on the 20th of February 2019. Right, immigration, so he's going to become a non-resident. Mike tells you that he spoke to a friend of his, Albert, who is a chartered accountant. Albert told him that there would be tax implications if Mike immigrated from South Africa, and he asked for a list of the assets Mike would have on the date of immigration. Hopefully, as you're reading this, you already went and understood why Albert is doing this. Mike provided him with a list of assets below and what he believed the market value would be on the date of immigration. After 2 days, Albert emailed him the following message. Hi Mike, thanks for sharing that whiskey on the weekend. Gave me a nice headache, but it was worth it. Mike, I had to do a bit of digging around, but I believe that in terms of Section 26A, you'll have to include 184,000 rands in your taxable income. I think as a sign you should just stay here in South Africa. I'll miss you, buddy. Good luck with the week, Albert. So, Section 26A is a section that tells you that you need to calculate the taxable capital gain in terms of the H schedule and include it in taxable income. So basically what this is saying is that there will be a taxable capital gain of 184,000 rands. Why would there be potentially a capital gain? Because you need to remember when you immigrate, Section 9H applies and it says there's a deemed disposal of your assets at market value, and I'm going to remind you, except for immovable property in South Africa and permanent business establishments, a permanent establishment assets in South Africa. So below is a list of the assets that Mike gave his friend. Mike has indicated that he wishes to sell the assets at a later stage once he has settled into his new residence in Italy. So basically what they're trying to tell you is he's not selling it before he moves. He'll have it on the date of immigration. So they give you the market value on the 19th and 20th of February. Remember, he's immigrating on the 20th of February. So basically Section 9H says you should look at the date immediately before. Sometimes they'll just give you the 20th of February and you'll have to use that obviously. So there's a house and a workshop, both of these note 1. These are the assets referred to in Part A, Issue 7. So let's just go and see. Alright, so Issue 7 was the house he had purchased and the new workshop. Okay, Mike has indicated that he recently put in a swimming pool at a cost of 150,000, which was not reflected in the information given in Part A. Okay, so this is an improvement, and improvements are usually added to base cost. But now already, what can we see here? The house and the workshop, these are immovable property in SA. So again, Section 9H says you are treated as if you sold everything at market value except for immovable property in South Africa and permanent establishment in South Africa. So, no Section 9H. Note number 2, personal vehicle, 350,000. These personal vehicles are used by Mike and his wife. They originally cost 580. Alright, nice personal use asset. No CGT, paragraph 35. Workshop equipment, note number 3. Mike will not transport the workshop equipment to Italy as he will set up a new workshop there. Mike has decided they will keep the workshop in South Africa as he may return to the company to create furniture for his South African clients. The workshop equipment has a base cost of 1.9 million rands. Now that is permanent establishment in South Africa, so thus no Section 9H. There is maybe a question whether or not that will be a deemed disposal, or disposal in terms of paragraph 11, which is the actual disposal section, if he's completely never ever going to reuse it again. But that is why they tell you he may return to the company to create furniture, right, to the workshop. So Kruger Rands, note number 4. Kruger Rands were purchased in 2009 for 120,000. This is the base cost, and this will be a deemed disposal. Then there's a speedboat, note 5. Mike's father was a boating enthusiast. Sadly, he passed away in 2006. In terms of his last will and testament, Mike's father bequeathed a speedboat to Mike. Okay, So we're seeing a little bit of section 9HA here. The speedboat had originally cost 500,000 rands when Mike's father purchased it, and on the date of Mike's father's death, the boat had a market value of 700,000. Now, if you're looking at Mike's father, that will be the capital gain there. From 700,000 proceeds, base cost 500,000. Because section 9HA says you're treated as if you sold everything at market value. But now what you need to remember, if we are looking at Mike, Mike will have the base cost, which is the market value on the date of death. This is per section 9HA. This is the date of death, 700,000 rands. But then they say there was a lot of disputes and arguments over the last will and testament, and because of this, the executive could only wrap up the estate in 2007. This is when the boat was finally transferred to Mike, and now it had a market value of 750. So Mike got it when it was worth 750, but section 9HA says this market value, 700,000 rands, down on the date of death, is you'll use. The reason for this is Mike sold it immediately. Now, there will be proceeds of 750,000 and their base cost will be 700,000, which is then correct. It will be the increase in the market value since the date of death, because the date of death is when it became Mike's property, basically. So the increase since Mike had it. That's why it works in that way. Right, it's a smart way which the act's written. Mike used the boat on weekends and it is 13 meters in length. Aha, so longer than 10 meters, so thus not personal use. So this means that this also is also a deemed disposal. Alright guys, so up to there. In the next recording we'll start with part A, the required, and start answering it.